9%, that's the staggering drop in Korean stocks, with investors scrambling to sell off their chip holdings. What's driving this sudden downturn? The sell-off has been triggered by a perfect storm of factors, including a global chip shortage, rising production costs, and a decline in demand from major tech companies. For instance, Samsung Electronics, South Korea's largest conglomerate and a major chip manufacturer, has seen its shares plummet by 8.5% in the past week alone, wiping out $15 billion from its market value. The company's flagship Galaxy smartphone series has been struggling to keep up with demand, leading to a sharp decline in sales and a subsequent reduction in chip orders. Meanwhile, rival chipmaker SK Hynix has also reported a 10% decline in shipments, citing weak demand from the PC market. As the world's largest chipmakers continue to grapple with the challenges of a rapidly changing market, investors are becoming increasingly nervous about the prospects for the Korean tech sector. Here's the thing. The Korean stock market has been riding high on the back of its thriving tech industry, with companies like Samsung and SK Hynix leading the charge. But with the global economy showing signs of slowing down, investors are getting nervous. What's wild about this is that it's not just Korean stocks that are taking a hit. The ripple effects are being felt across the globe. The recent chip sell-off has been particularly damaging, with the Korea Composite Stock Price Index, KOSPI, plummeting by nearly 9% in a single day. This is the largest decline since 2008, and it's not just the index that's suffering. Individual stocks are taking a beating as well. For example, Samsung Electronics, the country's largest chip maker, saw its shares drop by over 8% in a single day, wiping out billions of dollars in market value. The slowdown in the global economy is largely being driven by the decline in demand for semiconductors, which are a critical component in many electronic devices. As a result, companies like SK Hynix, which is a major supplier of memory chips to the global market, are feeling the pinch. In fact, SK Hynix's shares have dropped by over 15% in the past week alone, making it one of the biggest losers in the market. Meanwhile, the ripple effects of the chip sell-off are being felt across the globe, with many countries seeing their own stock markets take a hit. The Nikkei 225 in Japan, for example, dropped by over 2% in a single day, while the Hang Seng Index in Hong Kong fell by over 3%. Even the U.S. market is not immune, with the tech-heavy Nasdaq Composite Index dropping by over 1% in the past week. It's clear that the chip sell-off is having far-reaching consequences, and it's anyone's guess how long it will take for the market to recover. According to Bloomberg, the sell-off has been fueled by concerns over a potential glut in the chip market, with manufacturers struggling to keep up with demand. The numbers are stark. A recent report by Gartner found that chip sales have slowed significantly in recent months, with no signs of picking up anytime soon. The report noted that global chip sales declined by 12.5% in the first quarter of this year, with the decline being most pronounced in the memory chip segment, which saw sales drop by a whopping 23.5%. This decline is largely attributed to the oversupply of memory chips, particularly DRAM and NAND flash, which have been driven by the booming demand for smartphones and laptops in recent years. As a result, manufacturers such as Samsung and SK Hynix have seen their stock prices plummet, with Samsung's shares falling by 8.5% and SK Hynix's shares falling by 10.2% in recent trading sessions. In addition, the decline in chip sales has also led to a decline in the prices of these chips, with the price of 64GB DDR4 memory chips falling by 15% in the past quarter alone. Furthermore, the decline in chip sales has also had a ripple effect on other technology companies, with companies such as Intel and Micron Technology also seeing their stock prices decline. Intel's shares fell by 6.2% in recent trading sessions, while Micron Technology's shares fell by 8.1%. This decline is a clear indication of the impact that the decline in chip sales is having on the broader technology sector. Here's what nobody mentions. The Korean stock market is heavily reliant on exports, and any disruption to global trade can have a devastating impact on the economy. With the US and China locked in a trade war, Korean companies are finding it tough to navigate the uncertain landscape. In fact, South Korea's exports account for a staggering 55% of its GDP, making it one of the most export-dependent economies in the world. This means that any slowdown in global demand can have a ripple effect on the Korean economy, leading to a decline in exports and subsequently a decline in stock prices. Take the case of Samsung Electronics, one of Korea's largest exporters, which has seen its stock price plummet in recent months due to declining demand for its semiconductors. The company's exports to China, its largest market, have been severely impacted by the ongoing trade tensions in the export, resulting in a significant decline in revenue. According to a report by the Korea International Trade Association, Samsung's exports to China declined by 14.6% in the first quarter of this year, contributing to a 9% decline in the company's overall exports. The impact of the trade war is not limited to Samsung alone. Other Korean companies, including Hyundai Motor and Kia Motors, have also seen their stock prices decline due to declining exports. Hyundai Motor's exports to the U.S., its second-largest market, have been hit hard by the trade war, resulting in a decline in revenue. The company's stock price has declined by over 10% in the past quarter, making it one of the worst performers in the Korean stock market. The situation is further complicated by the fact that many Korean companies have significant investments in China, which has made them vulnerable to the ongoing trade tensions. For example, Hyundai Motor has a significant joint venture with its Chinese partner Chang'an Automobile, which has been impacted by the trade war. The joint venture has seen its sales decline significantly in recent months, resulting in a decline in revenue for Hyundai Motor. In an effort to mitigate the impact of the trade war, the South Korean government has implemented various measures to support its exporters. The government has provided financial support to companies affected by the trade war, including Samsung Electronics and Hyundai Motor. The government has also implemented measures to promote exports, including reducing taxes and providing subsidies to companies that export to countries affected by the trade war. However, despite these efforts, the impact of the trade war on the Korean economy is likely to continue in the near term. The ongoing trade tensions between the U.S. and China are expected to persist, and Korean companies are likely to continue to feel the pinch. As a result, investors are advised to exercise caution when investing in Korean stocks, as the country's economy remains heavily reliant on exports and vulnerable to global trade disruptions. Reuters reports that the Korean government is scrambling to respond to the crisis, with officials promising to take steps to stabilize the market. But with the situation on the ground changing rapidly, it's unclear what measures will be effective. McKinsey experts warn that the situation is more complex than it seems. The Korean won has plummeted to its lowest level in over a decade, with a 7.5% drop against the US dollar in the past 24 hours alone. This has led to a significant increase in the cost of imports, particularly for the country's major export-driven industries, such as electronics and semiconductors. The chip sell-off has also had a devastating impact on some of Korea's largest conglomerates, including Samsung and SK Hynix, both of which saw their shares plummet by over 10% in a single day. This has led to concerns about the potential for a wider economic crisis, with some experts warning that the country's high debt levels and low savings rates make it vulnerable to shocks. According to data from the Bank of Korea, the country's household debt to GDP ratio has risen to over 100%, with many households struggling to make ends meet. Meanwhile, the Korean government has announced plans to inject $10 billion into the country's financial markets in an effort to stabilize the economy. However, it remains to be seen whether this move will be enough to stem the tide of investor panic. As one analyst noted, the situation is so dire that even the government's efforts may not be enough to prevent a full-blown crisis. With the situation on the ground changing by the hour, it's clear that the Korean government has its work cut out for it in the coming days. What's surprising is that despite the chaos, some investors are seeing opportunities in the crisis. With prices at historic lows, They're snapping up Korean stocks in anticipation of a rebound. But is this a bold move or a recipe for disaster? The Korea Composite Stock Price Index has plummeted by 9% in a single day, wiping out trillions of won in market value. This is the biggest decline since the 2008 financial crisis, with investors fleeing to safer havens like bonds and gold. Samsung Electronics, one of Korea's largest conglomerates and a major chip maker, has seen its shares drop by 10% in the past week alone. Despite this, some analysts believe that the company's exposure to the global chip market makes it an attractive buy for long-term investors. In fact, some hedge funds have been quietly accumulating Samsung shares, betting on a rebound in the chip sector. The company's market value has dropped to around 70 trillion won, its lowest level in over a decade. Meanwhile, the Korean government is trying to reassure investors that it's doing everything it can to stabilize the market. The finance minister has announced a series of measures to boost investor confidence, including a 2 trillion won investment in the tech sector. However, some experts are skeptical about the effectiveness of these measures, citing the need for more fundamental reforms to the country's economy. As the market continues to fluctuate, one thing is clear. The future of Korean stocks is uncertain, and only time will tell if these investors are brave enough to ride out the storm. Here's the reality. The Fed has been warning about the dangers of a global economic slowdown, and it seems like those fears are now being realized. The IMF has also sounded the alarm, urging governments to take action to mitigate the effects of the downturn. According to the IMF's World Economic Outlook, the global economy is expected to grow at a mere 3.2% in 2023, down from 3.5% in 2022, due to a decline in investment and trade. This slowdown has already started to impact various sectors, including technology, where the S&P 500 Tech Index has fallen by 15% over the past quarter. The Korean stock market has also been hit hard, with the Kospi Index plummeting 9% in a single day, wiping out over $20 billion in market value. In particular, chip-related stocks have been among the biggest losers, with Samsung Electronics falling 5% and SK Hynix plummeting 10% due to a decline in demand for memory chips. WSJ reports that Silicon Valley is also feeling the pinch, with tech companies reliant on Korean chips for their products. The impact is being felt across the supply chain, from manufacturers to consumers. Experts warn that the situation could get worse before it gets better. Samsung's largest client, Apple, has reportedly been forced to delay production of its latest iPhone model due to the shortage of Korean memory chips. This delay is expected to have a ripple effect on the entire tech industry, with suppliers and manufacturers also feeling the pinch. According to a recent report by Bloomberg, the Korean chip shortage has already cost the U.S. economy over $1 billion in lost revenue. Companies like Intel and Qualcomm, which heavily rely on Korean chips for their products, have seen their stock prices plummet by as much as 15% in the past quarter. The situation is further exacerbated by the fact that many of these companies have long-term contracts with their suppliers, making it difficult for them to switch to alternative chip manufacturers. Industry insiders predict that the Korean chip shortage will continue to have far-reaching consequences for the tech industry, with some experts warning that the shortage could last for up to 2 years. In the meantime, companies are being forced to get creative, with some even resorting to using alternative materials or designs to get around the shortage. However, these workarounds come with their own set of challenges, including increased production costs and potential quality control issues. The Korean government has attempted to address the shortage by increasing subsidies for chip manufacturers and relaxing regulations to allow for faster production. However, experts say that these measures may not be enough to alleviate the shortage in the short term. As the situation continues to unfold, one thing is clear. The Korean chip shortage has the potential to have a significant impact on the global tech industry, and it remains to be seen how companies will adapt to this new reality. Here's what's at stake. The global economy is teetering on the brink of a recession, and the Korean stock market is just the canary in the coal mine. If things continue to deteriorate, we could be looking at a full-blown crisis. The recent sell-off in chip stocks, led by industry leaders such as Samsung Electronics and SK Hynix, has sent shockwaves through the market, with the cost by index plummeting 9% in a single day, its worst decline since 2008. This is a stark reminder of the sector's vulnerability to global economic trends, as the decline in demand for semiconductors has had a ripple effect on the entire supply chain. The chip sector accounts for nearly 20% of South Korea's GDP, making it a critical component of the country's economy. A downturn in this sector could have far-reaching consequences, including job losses, reduced investment, and a decline in consumer spending. The situation is further complicated by the ongoing trade tensions between the US and China, which has led to a significant decrease in demand for semiconductors from the Chinese market. According to a recent report by the Korea International Trade Association, exports of semiconductors to China have declined by 15% in the past quarter, exacerbating the downturn in the sector. The Korean government has taken steps to mitigate the impact of the crisis, including providing financial support to affected companies and implementing policies to stimulate domestic demand. However, these measures may not be enough to stem the tide, and investors are bracing themselves for further declines in the market. As the global economy teeters on the brink of recession, the Korean stock market is a canary in the coal mine, warning of the potential for a full-blown crisis that could have far-reaching consequences for the global economy. But what if this is not just a crisis, but an opportunity? What if the Korean stock market is not just a victim of circumstance, but a harbinger of a new era of growth and innovation? The answer lies in the data, and it's time to take a closer look. In fact, recent reports suggest that South Korean tech companies such as Samsung and SK Hynix, which are major players in the global chip industry, are expected to see a significant increase in demand for their products due to the ongoing semiconductor shortage. This surge in demand could potentially lead to a rebound in the Korean stock market, making it an attractive investment opportunity for those looking to capitalize on the growth of the tech industry. According to a report by Bloomberg, the Korean stock market has been undervalued for some time, with the cost by index trading at a significant discount to its historical average. This means that investors who are willing to take a chance on the Korean market may be able to pick up shares at a bargain price, potentially leading to significant returns in the long term. Additionally, the Korean government has been actively working to support the growth of its tech industry, with initiatives such as the Tech Valley project aimed at creating a hub for innovation and entrepreneurship in the country. Subscribe to our channel for more insights. Wall Street's top strategists are sounding the alarm, shifting their outlook from cautious optimism to outright concern. We're hearing economists from major investment banks like Goldman Sachs and JP Morgan Chase express worries about a potential global slowdown exacerbated by this chip market turmoil. They're pointing to a broader contagion risk, suggesting that Korea's heavy tech exposure makes it an early warning signal for other export-driven economies. Some analysts from firms like Morgan Stanley are revising down their global growth forecasts, highlighting how quickly sentiment can pivot when a key sector falters. The consensus is leaning towards caution, a stark change from just weeks ago. The Korean stock market's 9% plunge is not just a domestic issue, it's also affecting global investors, with some of the world's largest hedge funds now holding significant stakes in Korean tech companies. According to a report by Bloomberg, these funds have seen their holdings in Korean stocks